You don't need a better strategy. You need fewer opinions. That sounds wrong, because everywhere you look, traders are adding more indicators, more setups, more signals, more charts, and somehow still losing. Here's the uncomfortable truth. Most traders don't fail because they don't know enough. They fail because they know too much, from the wrong places. In the next few minutes, I'll show you 5 rules that feel backward, but if you follow them for 60 days, they can completely reset how you trade, and why price keeps moving against you. And the weird part? None of them involve finding a better entry. Or intermediate trader, you know this pain. You study charts. You mark levels. You wait for confirmation. You enter. And price instantly goes the other way. You think, what am I missing? So you search more. You follow more traders. You add more tools. And slowly, trading becomes louder, messier, more emotional. This video is not about adding another strategy. It's about removing the 5 things silently destroying your consistency. Rule 1. Cut the noise, or you'll never trust yourself. Let's start with the most uncomfortable one. Stop following signal providers. All of them. Free, paid, Telegram, Instagram, Discord. Not because they're bad, but because they hijack your decision-making. Here's what actually happens. You do your own analysis. You build a thesis. Open your confident. Then you open your phone. And instantly, your confidence collapses. Not because your analysis was wrong, but because authority entered the room. That doubt is deadly. Palestinians, I've lived this cycle. I trusted strangers over my own work. And when price moved exactly as I predicted, I wasn't in the trade. That's not a strategy problem. That's a self-trust problem. Markets reward conviction backed by process, not crowds. Here's the flip. Education is good. Prediction is poison. If someone tells you what to buy or sell, unfollow. If they teach you how to think, that's different. Your first 60-day task is simple. Create an information diet that builds skill, not confusion. Noise off. Process on. Rule 2. One setup, no exceptions. This rule feels boring. That's why it works. Most traders think success comes from more strategies. In reality, it comes from depth. I once watched an interview with a highly profitable trader. Her method shocked people. No indicators, no complex concepts, no fancy terminology. Just one setup, repeated relentlessly. She didn't care about naming market structures. She cared about execution consistency. And that's the lesson. One setup allows you to answer questions like, how often does this actually work? Where does it fail? How does it behave in chop versus trend? If you trade 5 setups, you never learn any of them. For the next 60 days, pick one strategy. Backtest it on at least 2 months of data. Then trade only that. Not because it's perfect. Breaking familiarity breeds confidence, and confidence beats complexity. 3. One trade can be enough. Here's a scenario you've probably lived. You take a clean trade early, it hits profit, decorative for the day. Then boredom kicks in, or greed, or ego. You take another trade, then another. By the end of the day, you've given it all back. That's not bad analysis, that's overexposure. Here's the counterintuitive rule. 1 and done. Define a realistic daily target, not a dream number, a practical one. When you hit it, stop. Close the platform. Walk away. You're not paid by the number of trades. You're paid for discipline. The market will be there tomorrow. Your capital might not be. This rule alone saves more accounts than any indicator ever will. 4. Risk small enough that fear can't touch you. Let's talk about the 1% rule. Not as math, as psychology. If your account is $100, you risk $1 per trade. That sounds pointless, right? That's the point. This phase is not about income, it's about emotional stability. Most traders blow up mentally before they blow up financially. They risk small, win, then get confident. Next trade, bigger size. Loss hits. Now fear enters every decision. Inconsistent risk creates emotional whiplash. The 1% rule removes that. Losses become information, not trauma. For 60 days, treat risk like training wheels. Once your behavior is stable, then you scale, not before. Rule 5. Turn feelings into data. But this is the rule almost everyone skips, and it's why they repeat the same mistakes. Keep a physical journal, not just entries and exits, but reasons. What you saw, why you entered, why you exited. At the end of 60 days, something powerful happens. You stop guessing. You know. Which days you trade best. Which mistakes repeat. And when doubt creeps in, you don't argue with emotions. You point to data. That's how confidence is built, not hype. Notice something. None of these rules are flashy, because markets don't reward excitement. They reward repeatable behavior. Most retail traders lose because they behave like crowds. Reacting, chasing, overtrading. These rules force you to behave like a professional, calm, boring, process-driven. That's the real edge. If this, you feel confused, remove opinions. You feel inconsistent, reduce setups. You feel emotional, reduce risk. You feel stuck, journal outcomes. Then that, confidence increases, execution improves, losses hurt less, progress becomes visible. Simple. Not easy. Trap, watching analysis after entering. Fix, analysis ends before execution. Trap, increasing size after wins. Fix, fixed risk for the full 60 days. Strategy hopping. Fix, one setup, no exceptions. Trap, trading to feel productive. Fix, trade to follow rules. Blaming the market. Fix, review the journal. Profit isn't hidden in complexity. It's revealed in discipline. The market isn't against you. It's responding to your behavior. For the next 60 days, subtract the noise. Commit to the process, and let repetition do the work. If you're serious, type "Practice Start" in the comments. That's day 1. Come back in 60 days, reply to your own comment, and tell us what changed. Because the traders who win aren't the ones who know more. They're the ones who do less, better.